Hi everyone and welcome back to our channel, Think, Explore, Learn. Today, I'm really excited to introduce a book that has been widely regarded as a classic in the world of investing, The Intelligent Investor by Benjamin Graham. This book, first published in 1949, provides a comprehensive and in-depth understanding of the principles and strategies of value investing. It's a must-read for anyone looking to expand their knowledge and skills in the field of investing. Throughout this video, we'll be exploring the key concepts and theories put forward by Benjamin Graham in The Intelligent Investor and how they can be applied to make informed investment decisions. Whether you're a beginner or an experienced investor, this book has something to offer for everyone. So, if you're ready to delve into the world of investing and want to learn from one of the greatest minds in finance, stick around and let's get started. How can you invest like Warren Buffett? Have you ever thought about investing in the stock market, but were hesitant due to the financial crisis, burst bubbles, and economic crashes we've witnessed? Well, there is a way to invest in the market that doesn't leave you at risk of losing everything: intelligent investing. Intelligent investing is a longer-term, more risk-averse approach to the stock market and was first outlined by Benjamin Graham in 1949. And it works. In the decades since The Intelligent Investor was published, many have used Graham's approach and made fortunes, including the famous Warren Buffett. In this summary, you'll learn why you should always ignore Mr. Market, why it's better to start your investment career with virtual money, and why the cheapest stocks are sometimes the most valuable. So, if you want to become an intelligent investor like Warren Buffett, make sure to watch this full video. Let's talk about the world of investing and the difference between intelligent investing and speculation. Investing can be a great way to earn money, but it can also be risky if you don't know what you're doing. That's why it's important to understand the difference between intelligent investing and speculation. Speculating is all about short-term gains and taking advantage of market fluctuations. It's a risky game because nobody can predict the future. On the other hand, intelligent investing is all about taking the time to rationally examine a company's long-term value. Intelligent investors focus on pricing and only buy stock when the price is below its intrinsic value. This margin of safety ensures that they are getting a good deal and that there is a probable margin between what they pay and what they will earn as the company grows. Think of it like shopping for a dress. You want to make sure that you're getting a good deal and that the quality of the dress is worth what you're paying for it. The same goes for investing in a company's stock. You want to make sure that you're paying a fair price for a company that has the potential for growth. While it may not be as exciting as speculating, the end goal of intelligent investing is profit. By taking the time to thoroughly analyze a company and make informed decisions, you can secure safe and steady returns over the long term. Intelligent investing requires patience and a long-term view. In this section, we've discussed the importance of following the principles of intelligent investing, which include analyzing the long-term development of the companies in which you invest, diversifying your investments to protect against serious losses, and understanding that your goal is safe and steady returns, not extraordinary profits. It's important to remember that investing is a marathon, not a sprint. By following these principles, you will be well on your way to making informed investment decisions that can help you achieve your financial goals. In the next section, we'll dive deeper into each of these principles and explore practical tips for how to apply them in your own investments. So stay tuned and keep exploring, learning, and growing your knowledge as an intelligent investor. Let's dive deeper into the importance of stock market history and how it affects our investments. As intelligent investors, we understand that looking at the history of the stock market is just as important, if not more, as looking at a stock's history. The stock market has always been defined by regular ups and downs, and it's crucial to be prepared for the unpredictable. Economic crises, like the Wall Street crash in 1929, are a fact of life and happen from time to time. To prepare for these inevitable events, we must ensure that we have a diverse stock portfolio and that we're mentally and psychologically prepared for a crisis. We shouldn't sell everything at the first sign of danger, but instead remember that even after the most devastating crashes, the market will always recover. By looking at the history of the stock market, we can get a better idea of its stability, and once we've determined that the market is stable, we can focus on the history of the company we'd like to invest in. We should examine the correlation between the stock price and the company's earnings and dividends over the past 10 years, and consider the inflation rate to see how much we'll really earn. The next key point from the book states not to trust the crowd or the market. Let's imagine the stock market as a person, Mr. Market. He's unpredictable, moody, and easily influenced. This can cause major mood swings in the market, going from too optimistic to too pessimistic. As an investor, it's crucial to be a realist and not follow the crowd or Mr. Market's mood swings. Just because a stock is performing well doesn't mean it will always be profitable. In fact, stocks that have been performing well are more likely to lose value in the near future. We are naturally wired to recognize patterns and see profits rising as a pattern that will continue. But it's important to avoid getting enticed by short-term gains and understand the basic principles of intelligent investing. As a defensive investor, your portfolio should prioritize safety and be easy to manage. To achieve this, you should aim for a well-balanced portfolio by investing in both high-grade bonds and common stocks in a 50-50 split, or 75% bonds and 25% stocks if you're extremely risk-averse. When it comes to common stocks, it's important to diversify by investing in at least 10 different well-known companies with a long history of success. A simple way to do this is by aligning your portfolio with successful investment funds. Don't forget to seek the help of an expert to make informed investment decisions. By following these principles, your focus on safety will eventually lead to positive results. Once you have set up your investment portfolio, maintaining it becomes relatively easy. You should regularly review the balance between your common stock and bond investments to ensure their profitability and alignment with your initial investment strategy, such as maintaining a 50-50 ratio. It is recommended to make these assessments every 6 months. Additionally, it is a good practice to seek professional advice once a year to further optimize your investment portfolio. With these tips in mind, you are well on your way to becoming a successful defensive investor. Our next section will cover the strategies for enterprising investors. To become a successful enterprising investor, it's important to adopt many of the same strategies as defensive investors. You will also divide your funds between bonds and common stocks, with a higher allocation towards common stocks, which are more profitable but riskier. Like defensive investors, it's advisable to consult a financial planner, but as an enterprising investor, you should see your planner as a partner in managing your money, making decisions together. Enterprising investors don't just limit themselves to bonds and common stocks, they also explore other high-risk, high-reward stock options. For example, you may come across an up-and-coming startup that you believe has the potential to be the next big thing. As an enterprising investor, you may choose to invest in this opportunity, but only with a small portion of your portfolio, typically no more than 10%. It's important for enterprising investors to remember to keep a balanced portfolio and to limit their investments in high-risk options to protect their money. Regular research and monitoring of your portfolio is crucial for maintaining profitability. The enterprising investor avoids following market trends. When stock prices fall, many investors immediately sell their holdings, while others try to take advantage of rising stocks before it's too late. This type of market trading is common, but it can be risky and driven by fear of financial losses. Relying on the market can be hazardous, as fast-rising stock prices may indicate that the stock is overpriced or a risky investment. Just look at the U.S. housing bubble, where everyone invested in housing as prices continued to climb, only to crash once the market realized that prices were not representative of their actual value. To avoid such scenarios, enterprising investors adopt a contrarian approach. They buy in low markets and sell in high markets, regularly monitoring their portfolio and evaluating the companies they invest in. They ask questions such as, is the management still competent, and what is the company's financial situation? If they determine that a company's stock price is growing without a corresponding increase in value, they sell before the market crashes. On the other hand, they look for opportunities to buy in low markets, just like Yahoo Incorporated did in 2002 when they purchased Inktomi Corp. For a bargain at $1.65 per share, after Mr. Market became depressed and the company's shares dropped from the previously overpriced $231 per share. Becoming an enterprising investor offers the potential for finding great deals. But is the effort of monitoring your portfolio constantly worth it? Absolutely, as this is where the best opportunities lie, but only if you get started smartly. The best way to launch your journey as an enterprising investor is by virtually tracking and selecting stocks. Practice virtual investing for a year to sharpen your skills in identifying a good deal and following the progress of your stocks. Nowadays, many websites allow you to make virtual investments with just a simple registration. This one-year practice period serves several purposes, including honing your investment knowledge and adjusting your expectations. Once you've had a year's worth of virtual experience, you're ready to hunt for bargains. The best place to find a deal is in the undervalued stocks of companies. These stocks are usually overlooked because the companies are temporarily unpopular or facing economic difficulties. For example, consider Company B, the second strongest player in the refrigerator market. The company has a good track record with stable, although not impressive, profits for the past 7 years. However, due to a production issue, the company has seen a dip in profits for the past 2 months, causing its stock price to drop as nervous investors sell. Once the production issue is resolved, the company will return to its previous state, and a wise investor will view the declining prices as a chance to get a great deal. Finding such opportunities is not easy, which is why practicing virtually first is crucial. If you succeed in the virtual world, you can do it in reality too. For a successful stock investment, it is crucial to adopt the mindset of a smart investor. By following the tips outlined in this book, you can reap steady and modest profits, whether you prefer a defensive or an enterprising approach. That's all for today's episode, where we explored the strategies to become an intelligent investor in the stock market. Investing smartly can bring you steady profits, and with the right approach, you can achieve financial success. If you're interested in learning more about investing in yourself for the long run, be sure to check out the rest of our videos on our channel. And don't forget to hit the subscribe button and the notification bell so that you never miss a video. We'll see you in the next one, where we'll continue to think, explore, and learn together.